Task Force on Monetary Policy, Treasury Market Resilience, and Economic Prosperity will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Striking the Right Balance Sheet. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 4 minutes for an opening statement. Welcome to the first Task Force hearing of 2026. Our focus today is on the Fed's balance sheet, a record of its assets and liabilities that demonstrate its operations. The Fed's balance sheet has undergone dramatic changes in the last 15 years, growing from less than $1 trillion in 2008, or 6% of GDP, to almost $9 trillion in 2022, or 35% of GDP. In 2008, the Fed moved from a quarter system to a floor system, necessarily demanding an increase in the quality of reserves on the balance sheet. Despite that change, the Fed has continued to express the view that reserves should be at the smallest levels, consistent with the effective implementation of monetary policy. We haven't always seen the Fed stick to that view, instead using its balance sheet to provide economic stimulus, not merely as a means to control rates. In 2008, the Fed engaged in 4 rounds of large-scale asset purchases, or QEs, with its balance sheet standing at $6.5 trillion today. Yet the academic literature shows mixed results on the effectiveness of QE at economic support. While the jury is out on the benefits of QE, we do know that it raises risks of inflation and market distortion. The Fed should rely on conventional monetary policy tools under its ample reserves regime and avoid market operations that may have unintended and lasting consequences. Additionally, the Fed should clearly articulate under what conditions it uses its balance sheet for economic stimulus, economic contraction, and policy implementation in the future. This is particularly important now as the Fed engages in reserve management purchases. Finally, it may be tempting to allow the news of the day to distract us from the purpose of today's hearing. I will continue to emphasize that the independence of the Fed is critical to ensuring it makes sound interest rate decisions that are essential to favorable economic outcomes. We'll do well to remember that decisions made now have lasting implications, not just for the next Fed chair, but for the next 10 Fed chairs. That said, let's focus our discussion today on the proper use of the balance sheet and its impact on monetary policy implementation and treasury market functioning. I yield back. I now recognize the ranking member of the task force, Mr. Vargas, for 4 minutes for an opening statement.
Thank you very much, Mr. Chairman, and I want to thank the witnesses for being here today. Mr. Chairman, you have assembled a very distinguished group of witnesses today, and I was looking forward to discussing quantitative easing and quantitative tightening, the transition between scarce and ample reserves regimes, and other aspects of the Fed's balance sheet. But the development of the past few days have been incredibly alarming. I don't see them as a simple distraction. The Department of Justice has threatened Chairman Powell with a criminal indictment. The threats represent a full frontal assault by President Trump on the independence of the Fed. Just 11 days ago, after the president said, quote, "We're going to probably bring a lawsuit against him," end quote, the Department of Justice served the Federal Reserve with grand jury subpoenas. This is not an isolated incident. In August, the president said he was considering allowing a major lawsuit against Powell to proceed, end quote. In November, he said of the Chairman Powell, "He should be fired and he should be sued," end quote. These repeated threats are designed to pressure the Federal Reserve into submission. Protecting the Fed's independence and credibility is critical to a stable economy. Credibility keeps mortgage rates low for home buyers. Credibility keeps borrowing costs predictable for small businesses. Credibility prevents credit card payments from spiking for working families. When monetary policy is guided by data and evidence, families can plan, save, and build financial security. When presidents attempt to interfere with the Fed, markets lose confidence, and Americans pay the cost. Congress imposed staggered 14-year terms to insulate monetary policy from political pressure. Yet, President Trump has shown he is willing to ignore that safeguard to reshape the Fed in his own image. Chairman Powell's professionalism, seriousness, and character have earned him respect across ideological and party lines. I agree with Chairman Hill when he says he knows Powell to be, quote, a man of integrity with a strong commitment to public service, end of quote. And Governor Cook's experience and academic background have made her a respected voice among economists and policymakers. Yet, the Department of Justice is threatening criminal prosecution. And next Wednesday, the Supreme Court will hear arguments on President Trump's attempt to remove Governor Cook. Let's be clear, this is not just about two individuals. It is about the future of the Federal Reserve, as the chairman noted. That's why all three living former Fed chairs condemned this criminal inquiry. They wrote, quote, "This is how monetary policy is made in emerging markets with weak institutions, with highly negative consequences for inflation and the functioning of their economies," end quote. Congress cannot stand by and allow this to happen. That's why I'm urging the Senate Banking Committee to follow Senator Tillis's lead and oppose the confirmation of any nominee for the Fed until this matter is resolved. The strength of our economy and our status as the world's reserve currency are on the line. And with that, Mr. Chairman, again, I thank you.
Gentleman yields back. The chair now recognizes the chairman of the full committee, Mr. Hill, for 1 minute for an opening statement.
Thank you, Chairman Lucas. I appreciate your leadership and that of the ranking member. The Federal Reserve's balance sheet is a monetary policy tool that was once deemed unconventional some 15 years ago. Now it's regularly used as a tool intended to keep our economy steady and secure. Since 2008, the Fed's balance sheet has grown significantly. What became as a modest tool used to support traditional monetary policy during times of stress appears to be the central way the Fed operates. Today, we'll examine that whole process. Quickly, before we turn to today's hearings, I do want to emphasize what Mr. Vargas talked about. Chair Powell is a man of integrity. This hearing today is not about these events that unfolded over the weekend. We have a good, solid monetary policy topic before us today, and I encourage all of our members to ask thoughtful questions about the direction of the Fed's balance sheet. Regarding the hearing on the Federal Reserve Semi-Annual Monetary Policy Report, the hearing is typically scheduled at this time of year, and the committee is at work to get it scheduled. Thank you, Mr. Chairman, and I yield back.
Gentleman yields back. Today, we welcome the testimony of Dr. Jim Klaus, Senior Fellow at the Anderson Institute for Finance and Economics, Dr. Bill Nelson, Executive Vice President, Chief Economist, and Head of Research at the Bank Policy Institute, Dr. Allison Schredger, Senior Fellow at the Manhattan Institute, and Dr. Bill English, the Eugene F. Williams Jr. Professor of Practice at the Yale School of Management. Each of you, first off, thanks to each of you for taking the time to be here, and each of you will be recognized for 5 minutes to give an oral presentation of your testimony, and without any objection, your written statements will be made a part of the record. Dr. Klaus, you may begin.
Thank you, Mr. Chairman, Ranking Member Vargas, and members of the task force. It is an honor to be with you here today to discuss issues related to the Federal Reserve's balance sheet. My name is Jim Klaus, and I'm currently a senior fellow at the Anderson Institute for Economics and Finance. Prior to joining Anderson, I was...
Doctor, would you pull the microphone just a little closer to you, please? Thank you very much.
Sorry. Prior to joining Anderson, I was on the Federal Reserve Board staff for many years, with much of that time spent focusing on issues related to the Federal Reserve's balance sheet and monetary policy implementation. The Federal Reserve's balance sheet is a term used to refer to its assets and liabilities. The Federal Reserve Act specifies the types of assets the Fed can hold. Federal Reserve's assets currently consist largely of U.S. Treasury securities and agency MBS securities. On the other side of the balance sheet, the Fed's primary liabilities include physical currency and reserve balances held by depository institutions. The Federal Reserve publishes a great deal of information on the balance sheet in a range of reports. Prior to the global financial crisis in 2008, the role of the balance sheet in the implementation of monetary policy centered around the use of open market operations to align reserve supply with reserve demand at the targeted federal funds rate. Reserve demand was driven largely by reserve requirements. Reserves did not earn interest, and banks sought to keep any excess reserves to a minimum. Fed assets at this time were almost entirely U.S. Treasury securities with an average maturity of about 3 years. Over the last 20 years, the Fed's balance sheet has undergone a major transformation, largely reflecting the policy actions taken in response to the global financial crisis and the pandemic. In both cases, the FOMC reduced the target federal funds rate to the effective lower bound and purchased large volumes of longer-term Treasury securities and agency securities in an effort to put downward pressure on longer-term interest rates and ease broad financial conditions. The expansion of the Fed securities holdings during these episodes was accompanied by large increases in reserves in the banking system. Over time, it became apparent that the demand for reserves had dramatically changed from that in the period prior to the GFC. Surveys of banks suggested that changes in bank liquidity regulations and a cautious approach to liquidity risk management have contributed to higher reserve demand. Partly in recognition of these changes, the FOMC announced in early 2019 that it intended to continue to operate in a so-called ample reserves regime. The ample reserves regime has many attractive features. First and foremost, it delivers excellent interest rate control, even in environments with very large quantities of reserves in the banking system. That said, there can be challenges in identifying whether reserves remain ample, a point that was painfully illustrated by a period of severe stress in money markets in September of 2019. Following the period of balance sheet reduction over the last few years, the FOMC judged that reserves had returned to ample levels and announced that it would begin reserve management purchases of Treasury bills to maintain ample reserve conditions over time. While the size of the Fed's balance sheet has now apparently reached a new normal, the composition of the balance sheet still has a long way to go. The FOMC has indicated that it intends to hold primarily Treasury securities in the longer run, but agency MBS holdings are still sizable and running off only slowly. Moreover, the maturity structure of the Fed securities holdings is heavily weighted towards longer-term securities. The FOMC's desired long-run composition of the balance sheet could depend on a number of policy considerations, including potential implications for future policy actions, Treasury market functioning, and Federal Reserve net income. Regarding other balance sheet-related issues, some observers have suggested that eliminating the Fed's authority to pay interest on reserves could be a way to boost Fed remittances to the U.S. Treasury. Eliminating interest on reserves would not boost Fed remittances because the Fed's interest income would fall along with a decline in interest expenses. Moreover, eliminating interest on reserves would necessitate very large and potentially disruptive sales of the Fed securities holdings and would require wholesale changes in the framework for monetary policy implementation with the attendant uncertainties about the Fed's ability to effectively manage the level of short-term interest rates. Thank you.
Thank you, Dr. Klaus. Dr. Nelson, you are now recognized for 5 minutes for your oral remarks.
Thank you. Chairman Lucas, Ranking Member Vargas, and members of the task force, thank you for the opportunity to testify. My name is Bill Nelson, and I am Chief Economist and Head of Research at the Bank Policy Institute. I previously served at the Federal Reserve Board working on monetary policy analysis, including balance sheet policy. The Federal Reserve's balance sheet matters because it shapes how monetary policy is implemented, how the Fed interacts with the financial system, and the risks ultimately borne by taxpayers. On the asset side, the Fed holds mainly Treasury securities and agency mortgage-backed securities. On the liability side, its largest item today is reserve balances, deposits of banks at the Fed, along with currency and the Treasury's general account. Because currency demand is set by the public and the Treasury controls its own account, the minimum size of the Fed's balance sheet is largely determined by banks' demand for reserve balances. Before the financial crisis, the Fed implemented policy in what is called a corridor system. In that system, the Fed only supplied the level of reserve balances that the banking system needed, and private interbank markets actively distributed liquidity and imposed discipline. The Fed had good interest rate control, even though its footprint in markets was tiny. After 2008, emergency lending, quantitative easing, and the authority to pay interest on reserves led the Fed to adopt a floor system in which a massive quantity of reserves pins money market rates to the floor created by the interest rate the Fed pays for reserves. In January 2019, the Fed formally chose to remain in that system. That decision has had serious consequences. First, the unsecured interbank market has withered. With an excess supply of reserves, banks no longer need to borrow from one another for liquidity management purposes. Second, an unconstrained balance sheet becomes an attractive source of funding for government initiatives. As FOMC participants warned at the time the Fed officially adopted a floor system, A large and unbounded balance sheet invites political pressure to use it. Third, the floor system may have encouraged complacency on the part of the Fed about interest rate risk. Quantitative easing transfers that risk from the private sector to the Fed and therefore to taxpayers. When short-term rates rose sharply in 2022 to 2023, that risk materialized in large Federal Reserve losses. Fourth, abundant reserves worsen discount window stigma. Borrowing becomes rare and signals distress, preventing banks, supervisors, and investors from viewing the window as a normal backstop. Finally, there is a ratchet in the demand for reserves. Reserve demand rises easily but falls only with difficulty because bankers and bank examiners grow accustomed to abundant and cheap reserve balances and make adjustments to make use of them. In 2008, the Fed estimated that a floor system required about $35 billion in reserves. Today, that figure is roughly $3 trillion. The Bank of England, the ECB, the Bank of Canada, and the Reserve Bank of Australia have recognized these costs and are shrinking their balance sheets and seeking to revive private markets. If the Fed wants to do the same, it needs to take 3 steps. First, move overnight market rates modestly above the interest rate paid on reserves, creating an incentive for banks to economize on reserve holdings. Second, avoid repo market volatility by conducting temporary open market operations to manage easily predictable variations in reserve supply and demand, such as occur on quarter ends and days with large settlements of Treasury securities. Third, reform liquidity regulations so that banks can count discount window borrowing capacity established with pre-positioned collateral as a source of liquidity. This single change would reduce reserve demand, make liquidity regulations more accurate, encourage discount window preparedness, and boost economic growth and employment. It would support growth by allowing banks to make loans to households and businesses, which they would then pledge to the Fed, rather than forcing them to fill up their balance sheets with reserve balances. In closing, turning a large institution is never easy, but the experience of other central banks shows that a smaller Fed, one that acts as a backstop rather than a market replacement, is both feasible and desirable. Thank you. I look forward to your questions.
Thank you, Dr. Nelson. Dr. Schrager, you are now recognized for 5 minutes for your oral testimony.
Thank you for the invitation to discuss with you today the size and composition of the Federal Reserve's balance sheet. I'm a senior fellow at the Manhattan Institute, where I research fiscal and monetary policy and financial markets. I'm also a columnist at Bloomberg Opinion. The size of the Federal Reserve's balance sheet has grown exponentially since the start of the financial crisis. This has happened for 2 main reasons. The Fed switched from a scarce reserve system to an abundant reserves or an ample reserve system, where it sets policy rates by paying interest on reserves. Paying interest on reserves means banks keep more reserves at the Fed, which is naturally going to increase the size of the balance sheet. And there are some advantages to this. It makes it easier to control the policy rate, especially when rates are near zero. And traditionally, the Fed bought mostly short-term treasuries with bank reserves, which, like reserves, are highly liquid and have a very short duration. But this changed in November 2008, when the first of 4 rounds of quantitative easing commenced, and the Fed used reserves to make large-scale purchases of longer-dated bonds and mortgage-backed securities. The size and scope of QE is the other reason why the balance sheet has grown as much as it has. Now, the ample reserve system, I guess, can be justified. It has made it easier in some ways to conduct monetary policy within reason without causing inflation. However, the growth of the Fed's balance sheet has not been completely benign, because the compositions of its assets can have a profound impact on the economy. Buying longer-term bonds and mortgage-backed securities not only introduce distortions into the economy, it might also threaten the Fed's independence in the future. Now, when the pandemic arrived and we risked a severe recession and great disruption in financial markets, the scale of the new QE program, QE4, was unprecedented. Cumulative purchases since 2020 exceeded $4.6 trillion, more than all 3 previous QE programs combined. And my primary concern is the risk QE introduces to the economy with very questionable benefits. The hope is that when the Fed reduces the supply of long-duration assets in the hands of the private sector, long-term yields will fall, providing a stimulative effect on the economy. And when short-term rates are near zero and can't go much lower, this might offer the Fed another avenue to boost economic demand. But whether the first 3 rounds of QE actually had a notable and long-term impact on interest rates is hotly debated amongst economists. One research paper found that while Fed economists found that QE did reduce the rates yield on 10-year bonds, academic economists found very little or maybe only a fleeting impact, and take that for what you will. So even if there is spotty evidence of QE's impact on long-term yields, it can still have a distortionary impact on the wider economy. Traditionally, bond markets are segmented. The Fed has a significant impact on shorter-term rates, say below 5 years, and less impact on longer-term rates, which are set in the market. And that market price conveys very important information about the price of risk in the economy, and it makes the foundation of how many assets are priced throughout the economy. When the Fed attempts to alter this rate, or simply just becomes a large and captive buyer of longer-term bonds, all these prices then have less meaning. In that case, risk can be mispriced, causing bubbles and financial instability. It also poses a financial risk to taxpayers because longer-term bonds are more volatile, or their price is more volatile because they have a longer duration than the Fed's liabilities. One estimate projects the cost of QE will be more than $760 billion. The evidence is stronger that buying mortgage-backed securities has a notable impact on the mortgage market by lowering the spread between mortgage rates and bonds. When the Fed resumed QE in March of 2020, there was apparent distress in the mortgage market, but the Fed kept buying mortgage-backed securities for another 2 years when the housing market had not only fully recovered, but was extremely tight as many Americans moved homes, refinanced, and home prices hit record highs. We're still feeling the impact of this policy error. More than 50% of mortgage holders have mortgage rates below 4% and cannot afford to move and take on a higher rate, and this is constraining supply in the housing market, making Americans less mobile and contributing to high housing costs. Another problem with QE is while it's relatively easy to implement, it is very hard to end. Ending QE too quickly, as we've seen, creates some major financial stability issues. And this creates an inherent asymmetry. QE can be implemented very quickly when the economy is weak, but must be ended very slowly when the economy is hot. Even more worrying, if QE becomes a regular feature of monetary policy, which it seems it has, this can pose grave risks for Fed independence. When this is a tool in the Fed's toolbox, it is just all too tempting to pressure the Fed to keep the entire yield curve low in order to reduce the cost of debt service or just lower the cost of mortgages to consumers. Japan attempted this at the cost of introducing major distortions into its economy. Firms stayed in business for years only because of the low cost of credit, and this misallocation of capital lowered economic growth and contributed to their lost decades. Listen, some increase in the Fed's balance sheet is not necessarily a concern. It can be part of a healthy and growing economy. But the reasons why the balance sheet has grown as much as it has and the changing composition of its assets should be a matter of grave concern for policymakers. There may be some justification for buying assets other than short-term treasuries in extreme instances of illiquidity in the spirit of fostering financial stability. But any such program should only last a short amount of time, perhaps 6 months or less, after the liquidity event has passed, and not be used as a way to manage economic demand or influence asset prices. I'm happy to take your questions.
Thank you, Dr. Stricker. Dr. English, you're recognized for 5 minutes for your oral testimony.
Thank you, Chairman Lucas and Ranking Member Vargas, for holding this hearing and inviting me to testify today about the Federal Reserve's balance sheet. The size and composition of the Federal Reserve's balance sheet reflect a range of policy decisions by the Fed. For example, lending and quantitative easing have significant effects on the balance sheet. One important choice affecting the balance sheet is the method the Fed uses to implement its conventional interest rate policy. These policies can be implemented in a variety of ways. One possibility employed by the Fed prior to the financial crisis is to implement policy with a relatively small balance sheet. That is, relatively low levels of securities and relatively low levels of reserve balances at the Fed, and then use securities purchases and sales to adjust the level of reserves to achieve the desired outcome for short-term interest rates. This approach is sometimes referred to as a scarce reserves or corridor system. This sort of implementation was no longer possible by late 2008 because of the huge increase in reserves resulting from the Fed's emergency lending and QE. As a consequence, the Fed began implementing policy using the interest rate it pays on reserves and other administered rates. Since leaving money at the Fed is completely safe and liquid, banks should not lend out funds at rates much below the rate paid on reserves, and so that rate should set a rough floor for market rates. This approach is sometimes referred to as an ample reserves or floor system, and it works even with a very high level of reserve balances. As the Fed shrank its balance sheet between 2017 and 2019, it considered whether it should return to a scarce reserves approach with a smaller balance sheet or stay with an ample reserve system and a larger balance sheet. In January 2019, the Fed announced it would stick with the ample reserve system. That decision reflected a balancing of a number of potential costs and benefits. One cost, as Bill Nelson noted, was the impact of a high level of reserves on overnight interbank funding markets. With banks holding very high levels of reserves at the Fed, they have little need to borrow and lend reserves to manage their holdings, and as a result, the overnight interbank funding market has become much smaller and idiosyncratic. On the other hand, the Fed viewed the high level of bank reserves under the ample reserve system as likely to contribute to financial stability. In the event of a shock to the financial system, there would be less need to add reserves, as ample reserves would already be in place. Moreover, problems at large banks, the failure of which could cause systemic problems, can be managed better if those banks have a larger cushion of reserves to draw on. In addition, by 2019, the ample reserve system had been in place for more than a decade, had been working well to allow the Fed to set its policy rate, and there were presumably risks associated with trying to transition back to a scarce reserves regime. When policymakers assessed the overall costs and benefits of the two systems in 2019, they concluded that staying with the ample reserve system was preferable. Some have expressed the concern that the Fed, by operating with a larger balance sheet, may encourage the view that it will use its balance sheet to address other non-monetary policy concerns, or be willing to ease policy to address fiscal stresses by monetizing federal debt. However, such concerns can arise regardless of the size of the Fed's balance sheet. Instead, these risks point to the importance of the Fed's monetary policy independence. The Fed should implement monetary policy to foster the objectives given by Congress, maximum employment and price stability, without regard for political or other pressures to use its tools for other aims. Thank you. I look forward to our discussion.
Gentleman yields back. We'll now turn to members' questions, and I recognize myself for 5 minutes for questioning. Dr. Nelson, the Fed maintains that a floor system provides more rate control, a safer banking system, a more resilient Treasury market. Do you share that view, and what are the risks? What are the downside risks of a large balance sheet?
Thank you, Mr. Chairman. No, I don't share that view. There's in fact generally widespread agreement across the folks that have studied this that both a scarce reserve system and an ample reserve system provide good interest rate control in normal times. Now, it's true that when the Fed has to expand its balance sheet in response to a crisis and reserve balances go up, what happens at that time is a corridor system naturally becomes a floor system. And the ECB indeed moved in and out of a corridor and a floor system with no difficulty during the European banking crisis. And that demonstrates that it's not necessary for the Fed to operate a floor system all the time with the attendant costs in order to be able to handle times of a crisis. Moreover, it's not true that the banking system is more resilient under a floor system. In fact, as we saw, one of the things that a floor system does is it increases discount window stigma, and it reduces the incentive for banks to be prepared to use the window. And as we saw in August 2023, the banking system is much less resilient if the banks are not prepared to use the discount window.
Continuing with you, Dr. Nelson, banking regulations like the liquidity coverage ratio, resolution requirements, and liquidity stress test incentivize financial institutions to hold reserves, growing the Fed's balance sheet. Should the regulators contemplate the impacts of liquidity requirements have on the size of the Fed's balance sheet, and what regulations need to be adjusted?
Yes, they should. So last week, we conducted a survey of our member banks and published the results of that survey this morning on what leads to banks to demand reserve balances and what policies could change them. The things that the banks listed was first and foremost their own risk management, but then also needing to pass liquidity requirements as well as discount window stigma. And they indicated that the things that would most effectively allow them to reduce their demand for reserve balances was to recognize discount window capacity in the liquidity requirements to which they're subject.
Dr. Klaus, if the balance sheet gets too large, Aren't we in danger of markets becoming dependent on the Fed for proper functioning? In a crisis, Fed intervention may be necessary, but in normal times, is the Fed unnecessarily distorting market behavior?
Thank you. I think that that is possible and certainly was a concern at the time when large-scale asset purchase programs were initiated, that the growth of the balance sheet could be too rapid and there could be problems in market functioning. In the event the FOMC carefully calibrated its pace of purchases and also tried to spread its holdings of Treasury securities across a range of CUSIPs to address those issues. At present, my own sense is that the balance sheet is not exerting any particular distortions in the Treasury market. An interesting fact is that the Fed's Treasury holdings now, as a share of the total Treasury market, are below those prior to the GGFC.
Dr. English, in my view, the primary benefit of QE is the strong signal it sends to the market that the Fed is committed to easy policy and supporting the economy through dramatic and unconventional actions. Can you talk about the importance of clear communication from the Fed as it manages its balance sheet, given that reserve management purchases are not intended to stimulate the economy? How can the Fed clearly communicate that to the market and differentiate it from QE? Hit your button, Doc.
I think I agree with you that QE works in part by just signaling resolve of the central bank. I think we may disagree over other possible channels through which QE can affect interest rates in the economy. But certainly communication about asset purchases is very important. And elsewhere, I've argued that the Fed should be clear about what the intended purpose of purchases is, and then the purchases should be designed and calibrated to meet that purpose. And I think that's important for clarity on the part of the Fed, for the understanding of financial markets, and so on. In the current situation, I actually think the Fed's done a very good job of explaining the reserve management purchases, which it started this month. It has said in its post-meeting statement that purchases of shorter-term Treasury securities, it will purchase shorter-term Treasury securities as needed to maintain an ample supply of reserves on an ongoing basis. So it was clear it was buying short-term Treasuries, not long-term Treasuries, as it would for QE aimed at easing policy. And it was clear that the aim was to supply reserves and not to provide accommodation.
Thank you, Doctor. My time's expired. I now recognize the ranking member of the task force, Mr. Vargas, for 5 minutes for questions.
Thank you very much, Mr. Chairman. Appreciate it. Again, I want to thank the witnesses. In fact, I don't want to violate any confidences here, but the chairman did lean over to me a second ago and say that we have a really excellent group that's testifying today, and hope you don't mind me saying that, but I agree. And I did hear the admonishment from the chair of the full committee that we should focus on the balance sheet today and not talk about the issues that have happened in the last few days. But I think for me, it would be irresponsible not to talk about the possible criminal prosecution of the chairman. I mean, I don't see how I cannot do that. I'm going to. In fact, in Chairman Powell's statement, he said this is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation. He went on, and yesterday the Wall Street Journal reported that Jeanine Pirro, the U.S. Attorney for the District of Columbia, was at a White House event last week with other U.S. attorneys where President Trump called them weak and said he felt betrayed. The next day, the very next day, her office sent out grand jury subpoenas to the Federal Reserve, which I think is outrageous. And it's interesting, too, and even in all of your testimonies today, you all talked about the balance sheet being able to be used for policy or political purposes. Interestingly, Dr. English, you mentioned whether it was small or whether it was big, that it could be used either way. It doesn't matter the size, it could still be used politically. And I think that that's the problem when we don't have an independent Fed. I mean, the reason the Fed was set up in the first place was to bring it out of the politics. That's why they have the 14-year staggered terms. Could you comment on that, Dr. English? Because I think that that's important for the discussion to hear. You know, it's impossible just simply to talk about this and not say, well, there's the balance sheet. It's important whether we shrink it, whether we grow it, whether it's in times of emergency when we need it or not, when it could be used politically this whole time if the president has captured it.
So, Congressman, When Congress set up the current structure of the Federal Open Market Committee and the Federal Reserve Board in 1935, they were trying to ensure that the Fed could operate independently, could operate in the public interest. There's a very interesting paper by Gary Richardson and David Wilcox looking at this that came out last year. In particular, Congress wanted to ensure the Fed was independent of the president, who might have political and personal incentives that would affect policy in ways that would not be good for the public interest. There are several pieces of the structure that help ensure this independence. As you say, 14-year terms for board members. They only turn over every 2 years. That limits the number of people that a particular president in a particular term can nominate to the board. In addition,
Unless he gets them removed by a pliant court, right? I mean, as he's attempting to do with Lisa Cook.
let me come to that in a moment. The votes of Reserve Bank presidents on the FOMC mean that there are voters who aren't subject to presidential nomination at all. And that provides additional independence. And Congress intentionally put in place the arrangement that the president could only fire board members with cause to protect the Fed from being used by the president to accommodate fiscal needs. So this was the structure that Congress intended. As you say, we'll see in some sense what the courts decide about this, but the intent, I think, at the time was clear, that Congress intended an independent Federal Reserve for the public good.
And I think it's functioned fairly well with exception. I mean, we did see an exception when Nixon, I think, pushed very hard politically to change the rates. I mean, I don't think it worked well. I mean, I don't think it worked well in Turkey. I don't think it worked well in other places when the central bank is not independent from the politics, the particular politics of the president or whomever the leader is of the country at that time. Isn't that correct?
I think that's right. As you say, in Turkey in recent years, there was a strong political pressure put on the central bank to leave policy easy for too long. They ended up with very high inflation there. And I think you mentioned Richard Nixon and Arthur Burns. That's another famous example where Burns was an advisor and confidant of Nixon. He wanted Nixon to be successful. And Nixon put a lot of pressure on Burns to keep policy easy. We see that in the Nixon tapes. We see that in Burns' diary, for example. And I think that did contribute, only contributed, there were many factors at play, but it contributed to the high inflation that we saw.
My time is up, and I thank you, and I think that's very dangerous what's going on right now. Thank you. I yield
Gentleman's
back.
time has expired. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, Vice Chairman of the full committee.
Well, thank you, Mr. Chairman, and I too am going to divert a little bit from my prepared questions because I just need to point out a couple of facts. This is my third Fed chairman since I've come into Congress in 2010, Ben Bernanke, Janet Yellen, and now Jay Powell. I was chair of something called the Monetary Policy and Trade Subcommittee, which doesn't even exist anymore. In fact, I have an article from 2016 of a much thinner and slightly less gray Bill Huizinga chairing a very similar hearing. John Taylor was one of our witnesses, Dr. Eisenbeis, also somebody from Cato. So we've been dealing with this, and I will tell you, at the time, there was friends of mine on the other side who were very critical of Ben Bernanke and his relationship with George W. Bush. There was a lot of us very critical of Janet Yellen and her relationship with Barack Obama. In fact, we were debating whether we were going to have to subpoena meeting logs, not notes, but logs of how often Janet Yellen was meeting directly with President Barack Obama. Interestingly enough, that was because people suspected collusion between the Fed chair and the president. And now we're seeing sort of the opposite. We're seeing a disagreement between the Fed chair. So this notion that there's never been political pressure and that there's always been an independent Fed and it's somehow sterile and completely independent is just a fool's errand to pursue that. The question that I have on this is dealing really with the balance sheet and reserve regime. Banks hold plenty of reserves and don't have many incentives to trade with each other in the Fed funds market. However, Fed funds market can be more susceptible to experiencing sharp changes when conditions change. Dallas Fed President Lori Logan suggested that the Fed should move away from this market, instead target a repo rate for monetary policy implementation. Dr. Klaus, Dr. English, I'm curious, do either of you believe this change, do either of you believe this change something the Fed ought to consider, and what would the benefit or challenge in doing so? Dr. Klaus.
Thank you. That's a very interesting proposal of my own. And I do agree that the federal funds market is different now than it was in the past. I think of it as largely a deposit market. I think it's maybe more stable than many people think, but there are good arguments for shifting to a broader concept of bank's marginal funding rate. I personally am a little uncomfortable with the use of a repo rate because I think that ties monetary policy more closely to Treasury financing needs, large non-bank financial institutions. So that's my view.
Real quickly, Dr. English.
I think I basically agree with Jim. I don't see a need for that, and I don't think it's desirable. And I think the current system operates pretty effectively. So
Okay.
I'm not sure I see a need to make a change.
Dr. Schrager, why does the Fed still use quantitative easing to stimulate an economy when the economic community has not agreed whether the QE is actually even effective in the first place? That was one of my first meetings with Ben Bernanke in my office. I'm a former realtor. I would watch interest rates all the time. And I had no other way of explaining other than an artificial lowering of the interest rates. He literally came out of his chair. He was so angry. He was like, we didn't have a choice. Seems like we were in a different position now, but why are we still using it?
Well, certainly when, we started with QE, interest rates were at a, very near zero, and we are in the midst of a very deep recession, and I think the Fed was under a lot of pressure to feel like it was doing something, and it was something. So I think as well it got revived. It was supposed to just be an extraordinary situation because this was, an extreme financial crisis, a very deep recession. But I think the concern is one, it went on for a really long time because it's very hard to get out of QE. And
Well, it's very, if you don't mind, I would say it's very hard to break ourselves of the low interest rate sugar high.
exactly. And then during the pandemic, it got revived even bigger. So again, going into the pandemic, interest rates were also near zero. So I think, as I mentioned, and I cited a paper that found that, Fed economists do find it effective, academic economists less so.
Well, I would note one benefits professionally, the other may not,
Well,
arguably.
I'm just citing the paper.
Okay.
But I think it is very tempting for the Fed to use it just because they said it needs to do something, and it is,
So I referenced Dr. Taylor as having testified. Would Taylor rule make sense, or any sort of rule? And I know the chairman's, but I'd love to get that.
gentleman's time has
in-
expired.
I'd love to get it in writing.
yeah,
You can respond in writing.
I think definitely I'm more of a fan of a rules-based framework rather than discretion, and I think that is sort of an issue with QEs. It does also leave open more discretion.
Chair now recognizes the gentlewoman from California, the ranking member of the full committee, Mrs. Waters, for 5 minutes.
Thank you so very, very much. I appreciate so very much Mr. Vargas and Mr. Lewis and this hearing that you have put together. And I would love to engage with you about the balance sheet. We should not be talking about anything but the independence of the Fed, our central bank. A few days ago, President Trump again escalated his tax on the Federal Reserve, this time through grand jury subpoenas, threatening criminal prosecution of the Fed's chair, Jerome Powell. This comes after months of Trump bringing baseless accusations against Fed Governor Lisa Cook to remove her from position. Next week, Cook's case will be before the Supreme Court, and I expect they will reject Trump's power grab. That's because Trump's attacks are not about transparency or accountability. It's about his desire to control the Fed, interest rates, and our money supply to serve his agenda and not to fulfill the Fed's statutory mandates. I commend Chairman Hill and others for speaking up, but this committee, with its clear authority over the Fed, must take a bigger role in defending the Fed's independence. Can I just keep talking? No, I yield back.
Gentlelady yields back.
Oh, I'm going to give me the whole 5 minutes? Well, let me just say this. I'm thinking that I'm doing the,
For the ranking member, yes, please finish your 5 minutes, of course.
okay, we're going to get to some questions here.
If you can yield it to me, I'll take it.
Okay, I think this first question is, it is imperative that our committee does everything in its power to defend the Fed's independence for the benefit of our constituents. Chair Hill, Mr. Lucas, I would like to yield to you for a question. What actions will the committee take to fight back against these efforts to undermine the Fed's independence, including stopping this latest attack on Chair Powell from continuing? Will you commit to holding a full committee hearing and a bipartisan investigation? Will you issue subpoenas to the DOJ, FHFA Director Pulte, and Treasury Secretary Bessent regarding their role in this latest attack?
Would the gentlelady yield?
And
Thank you for
so,
yielding.
Mr. Hill is not here, and so I expect that Mr. Lewis will answer for him.
The task force held a hearing in September entitled Less Mandates, More Independence, where we discussed Fed independence. It has been, I believe, the goal of myself and the full committee chairman to address these issues. I cannot speak for the full chairman of the committee, but I much appreciate the lady's points.
Thank you very much. I take back my time. Dr. English, time and again over the past year, President Trump has taken extraordinary actions to attempt to control the Federal Reserve. For example, his administration manufactured mortgage fraud allegations to fire, again, Governor Lisa Cook and seize more control over the Federal Reserve. And last week, his administration threatened Chair Powell with criminal charges. From your perspective as a former Federal Reserve official for 25 years, how does this political interference from the White House undermine the Fed's ability to make objective and sound monetary policy decisions?
Well, I trust that it won't. The Fed will stand tough. I think the statement by Chair Powell over the weekend was clear that he's not going to change his behavior as a result of this. So I think the Federal Reserve has legal protections for its independence, and we'll see what the courts say. But I'm hopeful that the Federal Reserve will continue to use its tools to get to foster its objectives set by the Congress.
Excuse me, Dr. English, do you remember, was it Mr. Trump that nominated and got Mr. Powell the chairmanship, the presidency of the governing board?
Yes, he was the one who nominated Chair Powell, that's correct.
And is it your experience that Chairman Powell has been able to work effectively on both sides of the aisle?
Certainly, that's my impression, yes. He has talked to people on both sides of the aisle. We know that because his calendar is public. And I think he is a very smart, talented public servant who's done a very good job.
So basically, he has the respect of both sides of the aisle, and hopefully the courts will see this and understand this. Is that right?
I would hope so, yes.
Thank you. I yield back.
Gentlelady yields back. The chair now recognizes the gentleman from Wisconsin, Mr. Fitzgerald, for 5 minutes.
Thank you, Mr. Chair. Since 2008 financial crisis, the Federal Reserve's balance sheet has expanded dramatically and remains historically large, even after a period of quantitative tightening. Dr. Klaus, from your perspective, how does a persistently large Fed balance sheet affect private market intermediation, particularly dealer balance sheet capacity? And does it risk crowding out banks and market participants that would otherwise provide liquidity in the Treasury market?
Thank you for the question. You know, I think that was an important question, particularly on the earlier rounds of quantitative easing, that the additional reserves and bloating bank balance sheets could cause capital constraints to buy more closely, but we didn't actually find that to be the case. I actually think Bill English did a major study at the time. More recently, as I tried to indicate earlier, the Federal Reserve's balance sheet in dollar terms is quite large, but its holdings of Treasury securities, while large in dollar terms, are actually quite modest relative to the size of the overall Treasury market. On the order of actually prior to the crisis. So my assessment right now is that the Fed's holdings of Treasuries are not having meaningful distortionary effects in markets.
Very good, thank you. Dr. English argues, I don't want to put words in your mouth, but I think this is where you're at, that the Fed's large balance sheet and ample reserve system impose little long-run cost, while Dr. Nelson and Dr. Schrager warn that it distorts markets, could ratchet it upward, and expose taxpayers to risk, ultimately. So, Dr. English, what concrete metrics should Congress use to decide when the Fed's balance sheet is too large in size relative to GDP, reserve balances relative to bank assets, market functioning indicators maybe, or taxpayer exposure? And if none of these work, what measurable limits should replace them, I guess is the question.
Congressman, I think there are several issues here. One is the question of distortions. I think, as Jim just said, if the Fed's holdings of treasuries got very large, that could distort the treasury market, but at the moment, holdings are not that large relative to the treasury market. I think it's unlikely there are serious distortions there. You could look at things like bid-ask spreads and things like that in the market, but I don't think that indicators of market functioning are particularly showing signs of concern. It is true that when the Fed does QE, it purchases longer-term securities. It takes interest rate risk onto its balance sheet. That's intentional. That is the way QE works. It takes interest rate risk out of private hands, reduces risk premiums in private markets, lowers longer-term interest rates because those risk premiums are lower. And whether that ends up with losses for taxpayers or not, or gains, depends on whether interest rates after those purchases end up being higher or lower than were expected at the time of the purchases. And on average, over time, those gains and losses you would expect to roughly offset. So I'm not sure there are big problems here. I would worry if the size of reserve balances got so big that it began to impede the ability of banks to do their job. But by creating the overnight RRP program, the Fed provided a safety valve where extra reserves can move out of the banking system. And what we have seen in the last year or so is, as the Fed's balance sheet shrank, that overnight RRP program shrank and is now essentially gone. And I think that's an indicator that the level of reserves is now manageable for the banking system.
Mr. Congressman, may I offer a view on the distortions?
Yeah, go ahead, sir.
Thank you. So while it's one way that the Federal Reserve's large balance sheet does distort Treasury markets is through the creation of reserve balances, which tends to make leverage ratio requirements more binding on the part of the banking system. Because reserve balances are a low-risk, zero-risk weight asset, when they're very high, leverage ratios tend to be more binding. That discourages banks and the bank holding and the broker-dealers owned by bank holding companies from intermediating in Treasury markets because that requires them to take on similar low-risk assets. Now, the banking agencies have addressed that to some extent recently by adjusting the supplementary leverage ratio requirement, but there remains the Tier 1 leverage ratio requirement, which is binding on other banks and continues to discourage Treasury market intermediation.
Very good. Thank you so much. I yield back.
Gentleman's time has expired. Gentleman yields back. Does the ranking member seek recognition for unanimous consent request?
I have a unanimous consent request to enter into the record a series of documents relating to Trump's attacks on the Fed's independence, including Chair Powell's statement on Sunday about extraordinary subpoenas and criminal threats from the administration, court documents relating to Trump's attempted firing of Governor Lisa Cook, and statements from myself, Chairman Hill, and other Republicans, Treasury Secretary Vincent, Wall Street executives, foreign central bankers, and all living former Fed chairs strongly opposing Trump's latest attack on the Fed's independence.
Seeing no objections, so ordered. Young lady yields back. The chair now recognizes the gentleman from Illinois, Mr. Caston,
Thank you, Mr.
for
Chairman.
5 amazing minutes.
Thank you. It's always a pleasure, Mr. Chairman. I'm going to channel my inner X-Files here for a moment. I was looking back over the history, and I love this task force. I think the chairman's done a wonderful job of leading it. We had a task force hearing just after Trump's first tariffs announcement. We had a task force hearing just after his attempt to fire Governor Cook. And we're now having a task force hearing just after the threats of criminal prosecution of Jay Powell. I don't think these things are connected, but if you're
My time
watching out
stinks,
there,
obviously.
watch when Mr. Lucas announces our next hearing. That's probably a good time to short the bond market. More seriously, I want to be clear, I completely stand with Secretary Powell. It is absolutely critical that the Fed be independent, that from the executive, they have to be able to make hard decisions, especially when they're politically unpopular. I can't believe we need to say that, but I hope that everybody in a position of power, public or private sector, takes the chance to make that statement, because he needs to hear that now, and our economy needs to hear that now. Mr. Chair, in addition to the extensive list that our ranking member just entered into the record, I'd ask unanimous consent to enter a statement from the European Central Bank.
Gentlemen asked by unanimous consent to enter into the record. Seeing no objection, so ordered.
This is a statement from the leaders of the central bank and its counterparts in the UK, Sweden, Denmark, Switzerland, Australia, Canada, South Korea, and Brazil, standing, quote, in full solidarity with Chair Powell and stating that central bank independence is a cornerstone of price, financial, and economic stability. I want to take a little bit of issue with what Mr. Huizenga suggested, that this is normal. Those leaders are not compelled to make those statements.
Will the gentleman yield?
No, I will not. I want to finish my comments here. Mr. Nelson, your organization represents the nation's leading banks, manage trillions in assets. Do you agree that the Federal Reserve independence is central to the strength of the U.S. economy and the U.S. dollar? Yeah. And do you agree that threats of a criminal investigation into a sitting Federal Reserve chair could undermine the institution's independence? Yes or no?
I'm sorry, I'm not prepared to answer that question.
Okay, well, I just would note that Jamie Dimon, who sits on your board, has said that those threats will likely raise inflation expectations and raise interest rates over time. Do you agree with Jamie Dimon?
I'm sorry, I think it's best that I stick to the Fed's balance sheet, which is the topic of today's
All right, well, I will just read a quote from someone who's not here. Thank you, Jamie Dimon, for stating reasonable facts about the undermining of our Fed Chair Powell. Thanks for standing up to the administration for their bullying. I salute you, sir. Sad that the politicians are scared of our leader. That was from the great Reggie Jackson, Mr. October. I want to move to our balance sheet. And I want to start with how QE started. Dr. English, there's a lot of talk about leaving aside Fed independence, although Fed independence certainly makes this worse. When's the next rate cut going to come? How far is, what's the size going to be? How should we think, or how should the Fed think about a lower bound so that they don't end up out of ammunition, which was, of course, what happened last time? Where should rate cuts stop if they indeed keep going forward?
So if what you mean is that the Fed should hesitate to cut rates, say, after they get to 1%, in order to keep their powder dry to cut later on, I think that's a bad idea. I think if the economy is weak and you think there's a real risk that you're going to end up at the zero lower bound, if anything, you want to cut rates faster because you want to stay away from the zero lower bound if you can, because that constraint, when it binds, is extremely painful. It means you can't provide as much accommodation as you would like. So I would disagree with that. I think, if anything, I'd do the reverse. As I get close to the lower bound, I'd cut a little bit more.
Okay, well, let me maybe shift then, and this is, I guess, for Mr. Schrager. There's this tension that the Fed will say publicly, as they should, that managing the assets on their balance sheet should only be dealt with from a balance sheet perspective. That's not done to affect monetary policy. Wink, wink, nudge, nudge, we all know it affects rates. There's been research suggesting that the MBS purchases in 2022 had the practical effect of making house prices go up, which of course we're now grappling with that on the other side. How should we be thinking about Pulte and Trump putting pressure on Fannie and Freddie to buy mortgage-backed securities right now? Is that not an intentional distortion of interest rates?
Well, I mean, Fannie and Freddie, in a sense, are a distortion of interest rates. But, yeah, I mean, that is, I guess, you could argue that is serving a similar role. But I guess the difference is at least it's happening in a different branch of government that is, The Fed's independence largely exists by keeping its narrow mandate. And, because it's not democratically elected in the same way other parts of the government are. So, I mean, I'm not really here to comment about whether or not, Trump's.
Is it
Gentleman's
functionally
time's
different at
expired.
Treasury or Fannie and
Gentleman's
Freddie
time's
buys them?
expired. Doctor can forward a written response. The chair now recognizes the gentleman from Louisiana, Mr. Fields, one of my old colleagues from the 103rd session of Congress, for 5 minutes.
Thank you, Mr. Chairman, and let me thank all the witnesses for being here today. We're here today to talk about balance sheets and monetary policy. Important stuff, no doubt. But there is an elephant in the room that we cannot ignore. Just a few days ago, the Department of Justice sent grand jury subpoenas to the Federal Reserve threatening criminal prosecution of Chairman Jerome Powell. And that raises a far more pressing concern than banks' balance sheets for the moment. Under the guise of testimony that Chairman Powell gave to a Senate Banking Committee last June, the President has chosen to strong-arm the Federal Reserve by putting forward unconscionable allegations against the long-standing bipartisanship practice that we've had with the Federal Reserve. Since being elected his second term, President Trump has failed to recognize any form of diplomacy when dealing with people who won't do whatever he says. Why should Chairman Powell, or anyone else for that matter, be subject to criminal prosecution solely for choosing not to engage in the president's partisan politics? Now, I've been in public service for a long time, and I've never, ever seen anything like this. Chairman Powell said it best. This is not about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, but it's about political pressure and intimidation. If a person as nonpartisan as Chairman Powell can be subject to these accusations, is there anyone in our government who is truly safe from similar prosecution? That's what we're really dealing with today. So on that, I have direct my first question to Mr. English. Dr. English, I appreciate you being here, and I know you have spent a good part of your career at the Federal Reserve. In all of your years studying the Feds, in all 112 years of its history, has the Department of Justice ever threatened to criminally prosecute a sitting federal chair?
Not that I'm aware of, Congressman.
Now, Dr. English, my second question to you would be, I want you to help me explain something to the folk back home in Louisiana. When the president goes after the feds like this one, when he threatens the federal chair with prison, what does that actually mean for families in Baton Rouge trying to buy their first home? What does it mean to a senior citizen in Shreveport living on a fixed income? Break it down for me. What happens to regular people when you shake the confidence in the Federal Reserve?
So I think the risk, Congressman, is that if the president were successful in undermining the Fed's independence, then monetary policy would be made in the interest of short-term political gain and not in the interests of the objectives set by the U.S. Congress, maximum employment and stable prices. The likely effect is that monetary policy will be too easy. Presidents often call for monetary policy to be easier. They rarely call for monetary policy to be tighter. And so the result would be higher inflation over time. There's a lot of empirical evidence that less independent central banks deliver higher average inflation over time, also more volatile inflation over time, I think. So granting central banks independence brings inflation, helps keep inflation low and relatively stable. So everyday Americans, as they look at this issue about central bank independence, they should be concerned that if independence is undermined, the effect will be higher inflation, higher costs of living, and more uncertainty, more volatility around the cost of living over time.
And my last question to you, Mr. Nelson. Your member banks need stable monetary policy to do business. They need predictability. So with that said, what's your feeling about the attacks on the Feds?
The witness will need to respond to that in writing. The gentleman's time has expired.
I thank the chair, and I yield back the House.
Thank you. The chair now recognizes the gentleman from Nebraska, Mr. Flood, who is chair of the Subcommittee on Housing, for 5 minutes.
Thank you, Mr. Chairman. The subject of today's hearing is exceptionally important. The Federal Reserve's balance sheet grew exponentially after the recession of 2008 and then grew again after the COVID-19 pandemic. This is part of a trend in Federal Reserve monetary policy over the last 20 years. In harsh economic times, the Federal Reserve purchases assets, whether it be treasuries, mortgage-backed securities, or other assets. Then in fairly stable economic times, the Reserve lets those assets roll off the balance sheet slowly as they mature. We've seen this escalation play out once. Back before the financial crisis in 2008, the Federal Reserve's balance sheet was only around $900 million. However, before the Federal Reserve began purchasing assets in 2020 to combat economic instability from the COVID-19 shutdowns, the balance sheet was already around $4 trillion. Today, the Federal Reserve's balance sheet is at $6.5 trillion, which is still higher than where the balance sheet was prior to 2020. If the Federal Reserve already has a $6 trillion balance sheet when the next recession hits, the Federal Reserve will be being more assets on top of their already elevated holdings. My concern is whether this is sustainable long term. If quantitative easing remains a tool in the Federal Reserve's toolbox in the event of economic turbulence, wouldn't a larger balance sheet in good times blunt the economic impact of that tool when things get tough? My first question, Dr. Klaus, Dr. Nelson, Dr. Schrager, would you mind reacting to that sentiment? How should we be thinking about the implications of a larger Federal Reserve balance sheet for future bouts of quantitative easing?
Thank you all for my comments. As you indicated, the Federal Reserve has embarked on those QE programs in response to very severe adverse shocks. I would not anticipate balance sheet expansion beyond just what was necessary to accommodate the trend growth in currency and other technical factors in normal times. It's true that the dollar magnitude of the Fed's current balance sheet is sizable, but it has, the Federal Reserve through the last few years has reduced the size of the balance sheet relative to nominal GDP quite substantially. So,
Mr. Nelson, Dr. Nelson.
Thank you. So I think the big challenge, the particular challenge, is that every time the Fed increases its size, that size gets locked in and it has to increase it further. So for example, as I noted, in 2008, the staff judged that $30 billion was needed to conduct policy of the floor system. Now it's $3 trillion. But importantly, when the Fed decided to adopt a floor system, the staff estimated that it would require $1 trillion in reserves. And at that time, in large part because Chair Powell wanted to be able to demonstrate that QE could be reversed, he indicated that, well, $1 trillion, I will support it at that level, but if it turns out to be $1.5 trillion, then I'll have buyer's remorse. 11 months later, the staff revised its estimate of the amount needed to $1.5 trillion. So I think that that's the fundamental tendency for the balance sheet to just have to keep growing is part of the severe problem with the approach.
Dr. Schrager.
Yeah, I agree with all of that. And I think what we're seeing as well is financial markets become very dependent on this. And I mean, that's one of the reasons why they've even had to end quantitative tightening already. Is, it's already sort of maintaining the ability to do the ample reserve system is sort of really limits the size to even shrink the balance sheet, and this is one of the reasons why it just seems to be growing and growing and growing.
The minutes of the Federal Open Market Committee meeting in December suggested that they would stop quantitative tightening, which would have continued to shrink the size of the Federal Reserve's budget over time. Dr. Klaus, Dr. Nelson, and Dr. Schrager, with the Federal Reserve's balance sheet still at $6.5 trillion and the end of quantitative tightening, how large can we expect the balance sheet to get after the next round of quantitative easing? And this is kind of a speed round because I have 50 seconds. Dr. Klaus.
It's hard to say because the quantitative easing episodes are really largely restricted to severe adverse economic shocks, so it would depend on how adverse those shocks are.
Dr. Nelson.
Right, and the Federal Reserve can't get any smaller than the sum of banks' demand for reserves and the Treasury's general account and the currency. Those things are going to be growing over time, which is why the Fed is currently purchasing securities in order to hold the level of reserve balances relatively constant. So it's going to grow over time, and as Jim noted, really the amount of quantitative easing that might be necessary if, again, they reached zero would depend upon the circumstances.
Dr. Schrager.
Yeah, again, it would depend on the nature of the shock and where the shock was, if it was in the mortgage market or even maybe corporate bond market or, what have you. But I think as we're seeing this, it's going to be bigger each time.
Thank you very much for your
Gentleman's
testimony. I
time's
yield back.
expired. The chair now recognizes the ranking member for a unanimous consent request.
Thank you very much. I have a unanimous consent to request to enter into the record a set of documents relating to the Trump administration's radical theory about the Federal Reserve lacking authority to transfer CFPB funds that was rebutted by former Fed officials, including one of our witnesses, by Democratic committee members, and by a federal judge.
Seeing no objection, so ordered. The chair now recognizes the gentleman from Oregon to speak for 5 minutes.
Good afternoon, Chair Lucas and Ranking Member Vargas. Thank you for holding this important meeting today on the balance sheets. And I'd like to thank our witnesses for being here today to discuss this very important issue. I will say I can't sit here and pretend that this is business as usual, because it's not. The Fed, which our committee oversees, I believe, is under attack by the Trump administration. And the American people cannot afford for us to sit around talking about our balance sheets and pretend that this is not happening. When I'm home in my district, people ask me, what do I believe? And I tell them, believe what you see right in front of your very eyes. And this is what I am seeing. This attack on the Fed threatens to raise costs, hurt retirement accounts, and mess with our entire financial system. As you know, the Fed is mandated to be independent of the president, and that independence has meant over the last year that the Fed has done what's best, I believe, for the American people, not catering to President Trump. And now the Trump administration is threatening criminal investigations into Jerome Powell, the Fed's chair, and attempting to use the Fed to play political games. Now, I would argue that this is not some partisan attack on Trump by Democrats. Global central bank chiefs and top Wall Street bank CEOs are supporting Chair Powell. Senior Republican senators on the Senate Banking Committee have come out against the investigation. Even Chairman Hill, the chair of this committee, said it, quote, creates an unnecessary distraction. I'm a moderate Democrat, so I believe my Republican colleagues from time to time. This is unusual, but it is necessary for us to tell the truth about what is happening. And let me tell you what happens if the president can bully or threaten the Fed chair. Interest rates become a political tool, inflation becomes a campaign strategy, and your mortgage and your job and your savings become collateral damage. So let's be clear here. This isn't the first time the president has done some foolishness that hurts our economy. In his first term, unemployment has risen to the highest rate since the Great Depression. And since he's taken office this time, businesses have had to pay over $1 trillion in tariff costs. That affects my state and the people of Oregon. Today, everyday items are still too expensive, and President Trump needs to stop playing games with our economy and our wallets and focus on making things cheaper. Attacking the Fed does not do that. So make no mistake, this attempt to intimidate the Fed isn't about justice or the American people. According to my staff, it's about the president's ego. You could argue about that. But I can't and I won't stand by and let that happen. I'll continue fighting to make sure that the Fed works for Oregonians and not our president particularly. Thank you, and I yield back.
Gentlelady yields back. The chair now recognizes the gentleman from Texas, Mr. Green, for 5 minutes.
Thank you, Mr. Chairman. I thank the ranking member as well. And I concur with something the ranking member said at the genesis of his statement, or perhaps it was at the closing, maybe it was at Revelations. He talked about the dollar as the reserve currency. It is the reserve currency of choice globally. And as such, it affords us some preeminent privileges that many other countries don't enjoy. I would like for you to indicate to me whether you think that losing its independence would have some impact on the dollar as a reserve currency of choice. Mr. English, would you kindly start, and we'll move from your left down the line.
Yeah, Congressman, I think that's correct. If the Fed were seen as not independent, and that would lead to real concerns about high inflation. I think longer-term interest rates would probably rise, and people would pull back some from holding dollar assets. So it would hurt the dollar's role as the world's reserve currency. The extent of that would depend some on how bad people thought monetary policy was going to be with less Fed independence. I think there also is a problem because there isn't a good alternative reserve currency. There isn't another market that is as big and as liquid as the Treasury market. So I don't know kind of how far that would go, but at the margin, it would surely reduce the use of the dollar as reserve currency, yes.
Thank you. Let me continue with Mr. English for just a moment more. Mr. English, there's a war for currency supremacy. You caused me to come into this line of thinking with your commentary. And there are other countries that would dearly enjoy having the prominence that our country has with its currency. The dollar is used in many ways. When we sanction countries, we can deal with them by way of manipulating the dollar, our currency. Does that concern you, our ability to impose sanctions, because we have allowed somehow our supremacy with the dollar to erode?
I think it would depend a great deal on what the alternative reserve currency was that emerged. I think if it were, euro-denominated securities, if there were EU bonds that were issued, for example, I'm not sure it would actually make a huge difference. If there was a big shift to the renminbi, for example, then of course there would be. On the other hand, I think the renminbi is a long way from being a global reserve currency because there isn't capital market openness in China, and so there are real limits to how much people want to hold their reserves in the Chinese currency.
Thank you for this. Next point. As a magistrate, I conducted many probable cause hearings, practiced law for a good many years. And it is a very basic, fundamental principle that you do not investigate without some cause. You just don't decide one morning that you're going to investigate the chair of the Fed. To do so without some cause, where is the cause? Where's the transparency that would lead the American people, and in fact the world, to believe that this is a legitimate investigation as opposed to a vindictive means by which a president can acquire control of the Fed? Where's the probable cause? By the way, this is rhetorical. I don't expect any of you to answer this, okay? Please don't. This is, without question, creating an erosion in the confidence that we will have in the Fed, saving one thing, President Powell. He has stood his ground. He's not a man who's going to allow the president to just walk over him. Mr. Powell, Mr. Chairman, if you hear this message, I thank you for what you're doing to stand your ground. Continue to have courage to take on this reckless, ruthless president who ought to be impeached. I yield back.
Gentleman's time has expired. The chair now recognizes the gentleman from Montana, Mr. Downing, for 5 minutes.
Thank you, Chairman Lucas. Since the 2008 financial collapse, we've seen the Fed's balance sheet increase substantially, as we've talked about here today. And I really appreciate the discussion we've had to evaluate the effectiveness of the Fed's balance sheet targets in promoting economic stability. I'm going to start my questioning with Dr. English. What would it look like if the Fed shrank its balance sheet to pre-2008 levels, both the dollar amount or as a percentage of GDP, and would that be a wise decision?
So I think we don't know exactly what that would look like. I think one of the reasons why the Fed has been hesitant to move to a smaller balance sheet is they don't know how that would play out. We don't really know what the demand for reserves would look like in a system like the one that we had before the financial crisis. And we don't know what stumbles there would be along the way back to that smaller balance sheet. So I think it's just very hard to say. The point I would emphasize, and here I'm going to disagree with Bill Nelson for sure, so you should ask him these questions too, but I think it doesn't matter as much as you perhaps would think. The Fed can implement policy with a bigger balance sheet or a smaller balance sheet. What's important is that it can successfully implement policy, and it can. I used to travel around a lot and talk to central bankers from other countries. They all implemented policy in different ways. They all thought their way was the right and obvious way, and everybody else was crazy. And I think the way that you implement policy is less important than that it simply be an effective way to implement policy.
Thank you, I appreciate that. Mr. Klaus, do you believe that'd be a wise decision?
No, I don't believe it would be a wise decision, partly for the reason Bill just described, that we don't really know what reserve demand looks like. And also, I think the world is quite different now than it was in 2007. Notably, the federal debt outstanding is much, much larger than it was then. And there are linkages now between repo markets and overnight funding markets and money markets now that are just much larger than they were in the past. And we don't really understand those as well as we would need to in order to be able to make that sort of move.
So we're not clear on the effect it would have if we brought the balance sheet, grow it too quickly or too much, what effect that would have on the market?
That's my view. I mean, we all like to have nice, smooth reserve demand curves, but the truth is we don't really have a good sound understanding of what those curves look like.
Thank you. There's been a lot of discussion in this Congress about maintaining the independence of the Fed, which I strongly support. This question is for Dr. Schrager and for Dr. Nelson. Is it easier for the Fed to lose its independence if its balance sheet is too large? And if so, are there policy recommendations that you have for Congress to consider? I'll start with Dr. Schrager.
Yeah, I mean, it depends what you mean by too large. As I said, it's not only the size of the balance sheet, it's also its composition. And, as it's buying assets other than short-term treasuries, certainly long-dated treasuries or mortgage-backed securities or, briefly corporate bonds, which other countries have gotten into, or even stocks, then you really do have a serious threat to Fed independence because it becomes all too easy for the president to say, I want lower mortgage rates, buy more mortgage-backed securities, or as we've seen in Latin America often, the cost of servicing the debt is way too high. We want the Fed to lower rates. I mean, large debt is traditionally the biggest threat to Fed independence, and that's certainly a risk we've been playing with for a long time.
Thank you. Dr. Nelson?
I do think that it puts risk to the Fed's independence. Back the way the Fed used to conduct policy, reserve balances were extremely low, so the Fed could get no bigger than the public's demand for currency in the Treasury's general account. But if the Fed tried to get bigger, it would lose control of monetary policy under the old regime. Under the current regime, the Fed's balance sheet is effectively unbounded, and that makes it a more attractive target, as several FOMC participants have indicated, for political manipulation. And we've seen that with the CARES Act, which directed the Fed to fund, to extend credit to middle market firms rather than Congress doing so itself, and the Fed did. We saw it with the FDIC borrowing from the Fed rather than the Treasury, which was bound by the debt limit at that time to fund its bailouts of uninsured depositors in the spring of 2023.
All right, thank you. In my last second, actually, Mr. Chair, I don't have time for next questions. I'll yield back.
Gentleman yields back. The chair now recognizes the gentleman from Illinois, Mr. Foster, who's ranking member of the Financial Institutions Subcommittee for 5 minutes.
Thank you, Mr. Chair, and to our witnesses. You know, I take it all of you have probably had a chance to read the statement on the Federal Reserve independence from, you know, all of the luminaries, you know, Ben Bernanke, Bernstein, Jason Furman, Tim Geithner, Phil Graham, Alan Greenspan, Glenn Hubbard, Jacob Lew, Greg Mankiw, Hank Paulson, Ken Rogoff, Christina Romer, Robert Rubin, and Janet Yellen. You've all had a chance to read that, I presume. And so my question to you is, if you'd been asked to sign, we're in the position there, if you'd been asked to put your name on that, would you have put your name on that statement, and why or why not? Just start from the right. Dr. English.
Yes, I would have.
Yeah. Dr. Schrager?
I mean, I don't like to sign statements, but I'm supportive of the spirit, yeah.
I'm sorry, I haven't read the statement, but I do think Fed independence is a national asset, a precondition for low inflation and prosperity. And I think the Fed is subject to congressional oversight, and this task force is an outstanding example of that oversight.
Yes.
I haven't read those particular statements either, but I'm certainly a strong supporter of Fed independence. Thank you.
Well, I urge you to, you know, take a while to read it. I mean, it was a very eloquent thing. There's a similar statement from international central bankers from everywhere, from, you know, Korea to to Canada to the Bank of England, and you know, they understand what's at stake, and they look on in sympathy when you see third world countries find their central bank come under assault, and you see the damage that does to the citizens of those countries, and we don't want to go down that road. And so let's say there are a number of things. One of the things that has come up here is the Taylor rule. You know, up there on the wall is for many, many years we sat there and had endless debates about whether you could replace the entire Federal Reserve with the Taylor rule, which is a little formula that has, I think, 1 or 2 free coefficients in it. And you know, just for example, one of its many shortcomings, it doesn't have anywhere in it the balance sheet of the Federal Reserve, which is obviously a big player in this. So you know, Albert Einstein has a famous quote that your theories of the world, of the universe, should be as simple as possible, but no simpler. And it always struck me that the monomania by the former chair about let's just get rid of the Federal Reserve and follow the Taylor rule, it just seems like that can't possibly work. And it's sort of mind-numbing to me to find that from going to having, you know, no freedom at all in the Federal Reserve be the position of the Republican Party, and now we have, well, everything the Federal Reserve does should be at the whim of one man, is now the current position. I just find that just hard to actually understand. Do you know, I find myself in the middle. You know, from time to time, you know, we'll go and download one of these macro models and make a few experiments. I'm very pleased that people have transitioned away from MATLAB to Python in those, but you know, and so there's a lot to learn, but there's also got to be a human part of that too. It's not just the models. And so I was just wondering what, you know, why we've been so proud for so long, and now we seem to have gone off course on this. Did any of you have comments on that, or, yeah?
I'm sorry, I missed the last sentence.
Well, just the, you know, why, you know, what is it that's really at stake here? When you say that instead of having thoughtful debate, partly quantitative and partly, you know, gut feeling for where markets are moving, and which is, I think, the only way that you'll have a workable monetary policy. And now all of a sudden we're sitting there just talking about, you know, whether just some guy trying to run a gang should order people. You're all familiar with countries where that's happened, and why is it we've not decided to fight for that as a country?
So if you're asking whether I think monetary policy should be done in a deliberative way based on data and judgments and assessment, sure.
Partly, and then there's a gut feeling part of it too.
I'm sorry?
And there's a gut feeling part of it too. You know, you run all the models you can, you average all the models in your brain, and then in the end, you know,
There's an element of judgment to all of these things.
Yeah, and so that seems to be the only way it'll work. And I was just wondering now, when you find that all of that hard work by brilliant people is just being run roughshod over, it's amazing that every credentialed economist in the country isn't standing up and yelling, at least as clearly as, those ladies and gentlemen on that list I just read off. Anyway, I just want to, you have important voices. You're up in front of an important committee of Congress, and it matters that we all stand up in this together.
Gentleman's time has expired. Seeing no other request for time, the chair would like to thank all the witnesses for your written and oral testimony today. Your input is invaluable as we, as a task force, try to address these questions of independence and the Fed balance sheet. Without objection, all members have 5 legislative days to submit additional written questions for the witnesses to the chair. The questions will be forwarded to the witnesses for their response, and witnesses, please respond no later than February 18, 2026. This hearing is adjourned.